Good evening. So tonight, we're going to do a top-down analysis of the markets. We're not only going to look at the technical variables of the markets, but we're also going to look under the hood. We're going to look at some market internals. So the McLean oscillator, fear greed index. I'll explain what they're telling us, why I believe that we're at a market turning point. We're then going to look into the overall, we're going to look at the stage analysis with regards to the indexes, kind of determine where we're at right now. We'll do that on the weekly time frame, which is where we're at right now. And then we're also going to look at it on the shorter term time frame, which is the 195 minute, to give us a general idea of where the market's heading in the intermediate term, so the next couple of weeks. A lot of people don't know that you could actually use stage analysis on the 195 minute time frame, which is half of the daily time frame. So you'll get 2 bars that populate instead of 1. And it can be particularly useful for analyzing where market direction is most likely to head, and also to figure out which stocks are displaying relative strength so you can align yourself with the strongest candidates, which is very important. We'll also take a look at the Great 8, is what I refer to them as, the 8 heaviest weight names in the QQQ, and also basically the liquid leaders of the market. So where these 8 names go, the rest of the market will follow. Why is that? Well, because these 8 names alone make up almost 50% of the QQQ index, and the tech index makes up almost, I think, 26% of the S&P 500. I'm not sure if that statistic is correct, but if it's somewhere within the 20 range, and it's more than significant enough to cause the S&P 500 to rise just by the QQQ going up on its own. But with that being said, after that, we'll kind of take a look at some of the stocks that I'm watching, the names that have been showing relative strength, and those that I will look to purchase if the QQQ breaks out of its current range, which we'll get into shortly. So let's just first take a look at QQQ on the weekly time frame here, because we could really identify where the market is right now from a longer term standpoint. So I'm going to pop up the stage analysis diagram up top right here. There's 4 different stages. In stage analysis, you primarily operate on the weekly time frame. That's how it was created by Stan Weinstein. So that just basically tells us where the market is from a longer term perspective. So as you can see, you have 4 different stages. You have stage 1. Well, I guess I'll start. This was a little bit of a funky stage 1, but sometimes when you have a stage 1 that happens so quick, you don't even have any kind of basing phase like you see on the diagram up top. But you'll have stage 1, which then will move into stage 2 breakout. So in the case of most recent bull market, here stage 1, stage 2 breakout. And then along the way, this is important, along the way that stage 2 breakout, you're going to have multiple market corrections. It's completely normal. This is where you have institutions taking profits from the most recent move up. You have institutions that are getting out of the way because they believe the market topped out, but you also have institutions that think that there's more upside. So you have a whole lot of reallocation with regards to capital, and then eventually that base will resolve itself. Doesn't mean it's always going to be the upside, but if it does turn out to be a correction, then it will continue higher, and you'll have, basically you want to think of these corrections as price, that consolidation as the launch pad for the next price move up. And you'll generally have at least 2 to 3 corrections in a strong bull market, as we did in the 2020-2021 bull market, which was, to be fair, one of the strongest bull markets we've ever had in history. So I wouldn't expect for them to always be like that, but then again, the markets do move at a much faster rate than they did, let's say, 20 years ago. So we'll see if my point really is that we're only in our first correction. So October it's known to be a very harsh month for the indexes, and everyone knows that, right? Or at least it's all over social media. But when it actually happens, for some reason, people are shocked. So with regards to seasonality, the indexes are falling right in line. Now, October, November, December are actually fairly strong months for the indexes historically. Now, we have also had the 2 largest crashes in the stock market over the course of the last 100 years that occurred in October, which obviously I'm aware of, but from a statistical standpoint, October is tends to be the month where, I can't recall the saying, but it's usually where bears gets caught off guard. So maybe we'll have the same kind of scenario here. But right now, the stock market is in a stage 2 uptrend. The S&P 500 is potentially entering a stage 3 topping area. So this could be the top for S&P 500, but either way, it's more than likely to see some sort of nice relief bounce to the upside. So through the lens of a short-term trader, we're still expecting some sort of bounce in the coming weeks. IWM is still in a stage 1. So if you're going to have a very powerful bull market, you need all 3 of the major indexes moving in unison. That's where you're going to get the most powerful moves. If you look back, with the interest of time, I'm not going to do it, but I guess I will. If you look back throughout the monster move that the QQQ had, and even the S&P 500, you're going to see that it was throughout April, so 5/8, up to late July. Same thing for the Qs, right? Well, the Qs have been even more powerful, but when it did break out, it was in the beginning of May up to late July. And at the same time, that's when the IWM broke out. A little later, late May is when it broke out. But you could see when the indexes had their most powerful move, all 3 were moving in unison. It's important that that's the case. If QQQ is moving up and the SPY is moving up, but the IWM is moving down, it's creating selling pressure, and you have more sloppy moves to the upside. Now let's take a look at the stage analysis on the shorter term time frames to identify where we're potentially heading in the coming days, weeks. You look at QQQ right now, you can see that we're now moving into a stage 1 territory, which means that we're just in a whole lot of chop. There's really not a whole lot to do right now. This is where you have people that, I don't mean to pick on anyone in particular, but this is generally where amateurs trade, right? It's where you're going to get chopped around. It's where you're going to take, there's a saying, death by 1,000 cuts. You get in, it looks like it's going to go up, and then it reverses. You get to the short side, it looks like it's going to go up, and it reverses, just like today. There was a sell-off. It looked really like a powerful sell-off that was starting. Then maybe you go short here, and then it just reverses on you. So it's just really a time to reduce our activity, stay on the sidelines, let those quote-unquote amateurs build out the foundation that will then trade when price finally resolves itself out of this base, whether it be to the upside or the downside. Now, I believe it's going to be the upside, and I'll make more sense of that when we look at the market internals. But with that being said, the major levels for the QQQ index right now are 363 and 351. I also want to point out that if we look at the daily time frame, I discussed this in my newsletter I think it was 2 weeks ago, that the QQQ could potentially undercut and reverse, and that's what we've gotten so far. So whenever you have an undercut in a large basing structure, if price does move back up to the top of the base, this undercut usually signifies that it's in the later stages of this base formation and that it's likely for higher prices. So I don't want to get ahead of myself. I'm never going to be bullish for any reason other than the technicals. Same thing for bearish. But if we do move higher, I'll be increasingly more optimistic. So if we take a look at the S&P, I'm not really too interested in S&P 500 because I don't really trade stocks that are revolve around it. But you could see that this is deeply oversold. It's at a potential trend line, although it's not confirmed by any stretch of the imagination. It's really only 2 bounces, so not a whole lot of weight there. But it is at a 200-day moving average while deeply oversold. It's now consolidating. It's potentially setting up for a double bottom right here. Low followed by a lower low. So really we're looking for a break over 432, which will be taking out not just this double bottom neckline, it would also be recapturing the 20 exponential moving average, which would be a step in the right direction. I don't think the S&P 500 will get up there for a couple more days, but you'd be surprised when the market sentiment is as bearish as it is right now. That means there's a lot of market participants that are short, and all it takes is one headline to cause a massive short squeeze because there's a lot of market participants that are caught on the wrong side of the trade, forced to cover. A lot of emotions get involved, and it's just a whole mess. So I lean to the bullish side. That's one of the reasons. But I also want to take a look here at some of the market internals. So this is the McLean oscillator. It may not make a lot of sense to you guys, but I'll make as much sense as I can here in a short period of time. So this basically gauges overbought and oversold levels of the broader market from a technical standpoint. Now what I like to do is I'll couple that with the overall market sentiment. Major market turning points occur at market extremes. So when the technicals are showing that we are very oversold, and the market sentiment is as well, is showing that the overall market sentiment is very pessimistic. There's a lot of negative news headlines. I have a lot of people in my DMs that are very confident bears for no reason other than the fundamentals. It usually tells me that we're going to be reversing fairly soon. And then when you couple with the fact that the QQQ is holding up as well as it has been, and it's potentially putting in a double bottom base while deeply oversold, it just like from a probability standpoint, based off of my experience, the likelihood that we move higher is it's higher. So with that said, let's take a look at this McLean oscillator. You could see that and I'll show you, historically how it's panned out. Back here, we were in a downtrend on this oscillator. We hit extremes right around here. And then you could use a downtrend line on this oscillator just like you can with price action. So it was in a downtrend, it broke above that downtrend, at the same time we got a cross on the MACD, and at that same time, the fear greed index, this is just something I've documented, was at 16 at that time. So market sentiment was very pessimistic and at an extreme level. Price action was as well, and there was basically telling you that there was some sort of shift. Demand was entering the market. This was July, this was January. So if we just bring this over here and we look at QQQ in January, early January, that was right here. So that's where we found a bottom, and that's also where price ran up over 17% in the QQQ index. If we go back here one more time and we look at the next time that same scenario played out, except the fear greed was at even more of an extreme, we broke that downtrend line. That was around mid-March, it looks like. Where was that? Was that March? Yeah, that was mid-March. All right, so that was mid-March right here. That's when we broke out and moved higher again. And I'll just show one more example. And then finally, we have, this looks like it was mid-May. Same scenario. Well, I'm not sure what the fear greed at that time was 25. We broke out. It was a little bit of a sloppy breakout, but nonetheless. And that was right over here. So mid-May, we broke out, had another move up. So now we have the same thing that's occurring. The fear greed was at 17. The MACD is about to cross up. We're right on the cusp of breaking that downtrend. That downtrend line has also been tested 3 times already. This is going to be the 4th knock at the door. The more times you test the trend line, it's telling you the more aggressive the opposing force is becoming, and the more likely that downtrend line or uptrend support is to be violated. So with that said, I think that there's a good chance that we are going to break out of this base to the upside, and that's where I'm looking to get involved in the strongest names. So then whenever you're entering a trade, which real quick, if we look at TQQ, this is what I would be trading if QQQ broke out. It's the leveraged version of the QQQ. It just offers cheaper contracts, which is good for the Discord group. So with that said, when we break out from this basing area, if I were to go long, whenever you're going long or short, entering any trade, you want to ask yourself 2 questions. Where did price come from, and where is it likely to go? Well, I could tell you it's more than likely to go to this 50-day moving average, this declining 50-day moving average, because that's going to act as a very strong resistance level. So that would be, your general profit-taking area right around here, kind of scale out as you move into that resistance. You don't need to go completely scale out, because you could always have something like this and it goes higher, but at least pay yourself a little bit. Never let a profitable trade turn to a loss. And then where did price come from? Well, it's coming from a basing structure where you put in a low and then a higher low, and it's breaking higher. So it's a bull. Basically, what I'm saying is it's a bullish structure. The price action recently has been bullish. You have some contraction of volatility on the right side of the base, which is a bullish characteristic. And overall, there's been some heavy volume buying days. It's a setup that I'm willing to entertain. So with that being said, we're looking for an upside break of QQQ. Now, if QQQ were to break out, what we want to do is we want to put ourselves, I don't know if I'm going to go over the grade 8s. I just feel like I'm really dragging this video out. We're at 15 minutes already. So here are the stocks that I'm watching right now. Apple broke out today. It broke out of this base before QQQ broke out of its base. So it's showing relative strength. So tomorrow I'm looking for some sort of pullback to this breakout location where I'll look to get involved. If it takes out tomorrow's high with like some sort of gap up, or excuse me, if it takes out today's high tomorrow with some sort of gap, or if it's in the here, let's say it just opens here and breaks right up, I might still entertain just buying it there. Generally, Apple and Microsoft lead the market up off of market bottoms. I guess it's just because they're blue chip names, they're seen as being quote unquote safer. So that's just something I've noticed over time. And it looks like that's what's playing out right now. Next would be Palantir. So Palantir, it had this very strong move up and then came down sharply and seems to be recapturing its footing. So what I'm looking for is for it to get above this base high again. Now if it pushes above this 1635 level, you want to see very strong volume coming in, see that there's demand for the name, that buyers are supporting the move up. Otherwise, you don't really want to get involved because the probabilities that it's going to pan out favorably are a lot less. So we're looking at that 16.3 level. And really the first place of significant resistance will be right here, this gap resistance around the 17 level. But of course, that's a 10% move, so you'd want to be taking your, some profits on the way up. This is also a resistance level right here. This 16.9 level, that's simply because you have a very heavy volume candlestick, bearish candlestick, and the high of these candlesticks is basically what it's telling you. There's a lot of sellers right here, and it's something that the buyers are going to need to chew through in order for demand to overcome that supply. So from a technical standpoint, all you need to know is that whenever you have a heavy volume bearish candlestick like we have here, the high of that candlestick, the high area of that candlestick is considered to be a resistance level. So 1635 for more aggressive traders would be entry. 1680 would be for more conservative traders, with your first price targets really being around the 17.8 area. Now going over to XPO, you can see we have a very nice base here. The longer the base, the more market participants that were able to get involved within that base, the more traders that have something to lose, right? If the trade breaks out to the upside, you were bearish, you're going to get squeezed, and if it breaks down, there's going to be more buyers that got trapped. So because of the longer base, because of the amount of market participants that got involved throughout this base, it basically means there's going to be a larger response when it does inevitably break out. So with that said, I'm definitely watching this one closely. We had this very strong bullish candlestick that caught my eye in late September, and it's been supporting the price ever since. So there's been a lot of relative strength here. You have the 50-day, 20, and 10 exponential moving average, the 50 simple moving average, all moving up to support and almost push price up. So if we can get above that 77 area, I'll be looking to go long. Let's take a look at PDD. This is a Chinese name, very volatile. You could see it's not for those with a weak stomach with regards to volatility, so you want to be careful there. But it has been holding up very well. And if we can get above this little basing area around the 100 mark, which is also psychological level, so it's a very significant level, we could see a very nice move, first price target being around the 103.5, and then really the sky's the limit there. Then your next price target would be $8, 109 area. I'm really just calculating the depth of this base and then using that to get my price target. We have Abercrombie & Fitch, which has been holding up very well. Didn't even know this company exists really anymore. Last time I saw anything Abercrombie & Fitch was in high school 15 years ago. But really, you could see that we had this sell-off that started on the 3rd of October. And now we have these long wicks here. So it's telling you that there's clearly some buyers that are stepping in. We're also right at the trending moving average, which is where a stock, if trending, is going to more than likely find support. And it has done so the last couple of months. So if this trend is going to hold, it's going to bounce right here. You use the high of the reversal candlestick as your entry point with the low of it as your stop loss. or you could use the low of day as your stop loss if you want to be more conservative. So 55 level would be your entry. And then as I just covered the stop losses, AMD is another good one. So here we have this basing area. It looks like an inverse head and shoulders really, but you have an area or a level of confluence. You have this downtrend line. You also have this 50-day moving average. So you have a level of confluence where there's two support levels. Really two resistance levels. Really there's three. You have this base resistance, you have this downtrend line, and this 50-day moving average that's declining. So the more indicators that are the same area, the stronger that resistance level is going to be, and the stronger the reaction is going to be to that area. So if we break higher, it's likely to be a very powerful move higher. If we get rejected, it's likely to be a very fast rejection to the downside. So we're really, it's tough to figure out the entry here. It'd probably be, so you have a high volume bearish candlestick here, which is going to be resistance. You also have the 50 moving average there. So I think that the best entry point for me, considering I'm conservative, would be the high of that candlestick. By then we would have already cleared this downtrend line. We would be clearing the 50-day moving average, and we would have already made a higher high. So that's the kind of scenario I want to get involved with. Now, the downside of being a quote-unquote more conservative trader is that you're missing a good portion of the move that the aggressive traders can be rewarded with. So there's obviously trade-offs. If you're more aggressive, you're using the 105 high as your entry point. So yeah, it's a nice setup here. There's clearly some relative strength over the course of the last couple of days. Now, NVIDIA, you can't even, this is the dominant semiconductor name, but very expensive contract. So, and then finally we have TTD, the trade desk. You can see that it's holding up very well last couple of days, and it's just below that 50-day moving average. It's finding support at the short-term moving averages right now, and I'm looking for a break over the 79.70 area. And you could use low of day as your stop loss on this if it does break out here. But it moves kind of weird. So you can see usually the first 30 minutes of the day you're gonna see a huge surge up or a huge surge down. So be cognizant of that. These are the kinds of stocks where I prefer to have cushion prior to swinging it. If I don't have that cushion, it's just a little less comforting holding it overnight, but it doesn't mean it can't be done. If we break that 50-day moving average, there's going to be a strong reaction regardless, and that should give you enough cushion if you're looking to swing it. Now, I kind of skipped these, but I'm going to give you a quick rundown of what I'm seeing. So using the stage analysis on the 195-minute time frame, I'll just do it real quick. You can see that, so what I'm going to go over right now is how many of these stocks are in stage 1, 2, 3, or 4 on a short-term time frame. So the more names that are in stage 1 or 2, the more likely we're in a bottom. The more names that are in stage 4, the more likely we see more downside. Because once again, these are the heavyweights. Where these go, the market does. So NVIDIA is in stage 2. Apple is just moving into stage 2 as of today. We have Microsoft that is in stage 1. We have Google that's in stage 2. We have Meta that's in stage 1. We got Tesla that moved into stage 2. We have Amazon in stage 1. And we have Netflix, which is an abomination, that is in late stage 4. So what we pull out of that is that most of these heavyweights are now in stage 1. They're no longer in stage 4. They're now in the consolidation phase. So these stage 1s can either turn into stage 2 breakouts, which I think they will because of where we are with regards to the market extremes, or we're going to base and then its price is going to resolve itself back down to the downside. So we kind of just have to wait and see, but my bias is kind of bullish right now. You also have IWM that's still in stage 4, S&P 500 that's still in stage 4, although it looks like it's starting to move into stage 1. And then you have QQQ that's potentially moving into will move to stage 2 if we break up this 363 level. So I threw a whole lot at you, especially if you're new to technical analysis. Sorry if I overwhelmed you. Let me close things up real quick by making a point here that there's no stock that can be considered too safe, and to never just blindly buy anything. Like Coke is considered that quote-unquote safe name because it's Coke. Everyone loves Coke. people buy it because it's a dividend stock, right? But here's the deal: if you're in an environment where yields are rising, bonds are rising, the 10-year is rising, it makes dividend stocks like Coke a lot less appetizing, because why would you take a stock that's paying out a 3.3% dividend when you could buy a bond that's going to give you a 4.7% return? So because of that, you have huge outflows. You could see this is institutional selling out of safe, quote unquote, safer names like Pepsi. Pepsi's down 5% a day. Procter and Gamble, Coke, all names like that. So these stocks look like they're on a quote unquote discount right now, but this is more than likely, especially if bonds continue to rise, going to only exacerbate over the next couple of weeks. These stocks are in stage 4 downtrends now, and they really shouldn't be seen. There's going to be a bounce, without a doubt. There's going to be a bounce, but I would not be a bargain hunter with these names right now. You got to wait until there's some kind of technical reason to buy it. You also said a death cross on Pepsi and probably Coke. Oh, Coke already had that death cross. And then Procter and Gamble, they're starting to, line up for potential death cross. So my point is, there's a lot of people that say stocks like Coke, Pepsi, Procter and Gamble, really any dividend paying stock is a safe buy at any point in time. It doesn't matter. But in reality, this is what the highest dividend stock in the stock market. Well, well, if you bought it back in 2016, you're now down 55%. So if you think that the dividend that you were claiming throughout this period of time made up for that 55% decline, well, I would not recommend finding out for yourself. So anyways, I digress. I hope this was you learned a lot from this video. You now have some stocks to watch. And if you have any questions, feel free to reach out. Thanks.